Hey, Steve Saretsky here. Welcome back to the show. Quite a bit to touch on this week. I want to touch on what's happening in the mortgage lending space in Canada. We've seen a lot of changes, not just from CMHC last week. We got some updates from OSFI this week. We've got some updates in the rates markets, what's happening in the lending environment, and as well as what's happening now in the resale housing market, because I think all this is all, of course, connected. So last week, you guys will see I did a video on the CMHC changes. I highly encourage you to go watch that, where the government, the federal government asked CMHC to change the insured mortgage purchase price from $1 million up to $1.5 million. So effectively, if you're buying a $1.5 million home now, all you have to do is put down a minimum of $125,000 down payment. I think that's batshit crazy. It is stimulative for house prices, but as I alluded to in that video, I highly encourage you to watch it. I akin this to a bailout for the banks and for the development community. So I think that was horrible policy. It's something that the federal government lobbied against for years and years and years. And of course, out of the blue, as they fall further and further into the polls, pulled a complete 180. But I'll give them credit this week because they did bring in good change for once, and that was the mortgage stress test change. So let me break this down for you, because there's a lot of people, when I put this out on Twitter, they didn't really understand. They just immediately think, oh, the government's boosting housing. No. This is not at all what the change is done. So the mortgage industry, including friends like my good friend Ron Butler, have lobbied for removing the mortgage stress test on renewals. Not removing the mortgage stress test in general, just removing it on renewals. So how it works on new purchases is anytime you want to go buy a house, or you've sold your house, you're going to go buy a bigger place and you need a new mortgage, you have to get stress tested. And the stress test is whatever you're borrowing at. So let's call it today, you're borrowing at 4.5%, tack on 2%. So the bank qualifies you as if you're borrowing at 6.5%. So of course that lowers your leverage ratios. It lowers how much you could actually borrow. So that's designed to slow the growth in home prices. I think we can all argue that's probably pretty good policy. Where it didn't make sense is on renewal. So most people aren't aware of this in Canada, and it's kind of crazy, but it is what it is. And let's be honest, it's not going to change. If you have a 5-year, let's call it a 5-year fixed mortgage in Canada, and you've paid every mortgage payment, you've never been late, you've always been a good borrower, you paid on time. What happens is at the end of that 5-year term, the bank will send you an auto renewal letter. So you're going to get a letter in the mail. It's going to say, hey, your term is up. Here's a new 5-year rate. This is the rate that we're giving you. Basically, it's essentially sign on the dotted line. So you might have lost your job. You might, maybe your spouse stopped working. Maybe you got 4 more cars, all with lease payments on them. They don't check that, okay? So long as you are up to date on your mortgage payment and you've shown signs that you don't miss payments, it's an auto renewal letter, okay? So where the stress test didn't make sense is that letter would come in the mail. That letter would come in the mail and you'd be like, well, that's not a very good rate. TD Bank is offering me 5.5%, but the market's like 5%. Why am I being offered 5.5%? And so if you wanted to go to Scotia or RBC or, pick your bank, you'd have to get stress tested. So they would say, if you wanted to leave that bank and go to a different lender, you would have to get stress tested. So it actually forced people to basically get stuck in a lot of circumstances, to get stuck with a lender and not be able to move their business and not be able to shop around. And of course, if the bank knows this, of course, they're not going to be incentivized to give you a competitive rate. And so this is a non-competitive policy, and you've already got this monopoly or oligopoly in Canada regarding the banking system. So this is not good for consumers. Now, keep in mind, if you're going to move your mortgage, so you're going to leave TD and you can go to Scotiabank still underrates your file. They still have to go out there and qualify you. So they're still going to, when you leave and you go, I'm going to Scotiabank is going to check your income. They're going to check your debts. They're going to run your debt servicing ratios, just as they are required to, but they know they don't have to apply the stress test. But it's a simple port. You're bringing your existing mortgage over. You're not asking for more money. You're not asking to extend the amortization. You're just simply bringing the remaining balance over, and the remaining term over. So you started a 30-year out and now you're down to 25. You're just bringing the whole thing over. Under the new changes, you no longer have to be stress tested. So again, in my opinion, this is good for the average household. This is good for the average borrower. It forces banks to be more competitive. And we can all agree that banks are not very competitive in Canada because you have these oligopolies here that are running the show. So what does this mean for the market? Like, all this is going to do is this is going to save the average home owner 20, 25 basis points whenever they renew their mortgage, whether it's today or 6 months, 12 months from now. They're going to be able to shop around and they're going to be able to leverage 2 or 3 different terms that they were quoted at different lenders, and they're going to be able to ask them to compete for their business. And so they should save, again, 10, 20, 30 basis points on their mortgage. In my opinion, that's a win-win for the consumer. Funny enough is that when the stress test was originally brought in, they agreed behind the scenes to sign off and say, okay, we'll do the stress test. We'll go along with you, Mr. OSFI banking regulator. But in order to do this, we want a stress test on renewals. We want to basically be able to lock people in at the banks and not allow them to leave. And if they want to leave, they're going to have to get re-stress tested. That was the request of the banks because, again, in order for them to sign off on the stress test, that was basically one of their requirements. So it's nice to see government to finally getting involved here. Again, albeit a little bit late. This is a no-brainer policy. So that's number one. So we combine all these changes. There's lots going on in the rates market. Of course, we know a couple of weeks ago the Fed cut rates by 50 basis points, which really gave the Bank of Canada breathing room. As I said, this was breathing room for the Bank of Canada. You can't deviate too far away from the U.S. And so by the Fed cutting 50 basis points, there's now growing concern or growing consensus that the Bank of Canada will cut 50 basis points at the next meeting or one of the meetings coming up. But if you look at what the markets are pricing, okay, the OIS, overnight interest rate swaps market, what they are pricing right now is about 60% odds of a 50 basis point cut from the Bank of Canada next month. So what do we have going on here? We've got rates that are coming down. We've seen a drop in the bond yields as well. So your fixed rates are coming down. If you go do a broker check right now, you got to fight. You got to ask for it. You got to twist a few arms, but we're getting there. We're starting to see 5-year fixed rate mortgages uninsured at 3.99. Again, that's for a very well qualified client. You gotta have a larger mortgage size. It's got to be the right profile of borrower, but we're starting to get under that 4 psychological mark. So I think this is really important here because, again, we're starting to see rates come back down under 4%. And funny enough is, when the Bank of Canada started cutting rates, every homeowner I chatted with said, oh my God, they're cutting rates. We just keep our price here. Or maybe you should raise our price. Prices are going to go up tomorrow. They're going to go up. They're going to go up. They're going to go up. It's funny enough because we're 75 basis points in. We might even get 50 next month. So we're going to be 125 basis points worth of cut. And the market has not moved. It's still frozen. Listings are still growing. And I warn people that this might be the possibility. Remember, when rates were going up, it did the opposite. Instead of inventory flooding the market, people actually withheld inventory. In fact, new listings were hitting 20-year lows in Vancouver and in the GTA for 4, 5, 6 months at one point. And so funny enough is that once rates actually have started coming down, we're seeing new listings and the inventory levels are actually growing. They're growing, and they're growing into the fall market. So boots on the ground is the market right now is still slow. Showings are limited. You're getting a bit more inquiries, but there's just a lot of inventory that's coming to market. There's a lot of stuff that's sitting, and as it sits and more comes on, the months of inventory kind of just keeps growing. And so this was the one concern that I flagged many, many months ago before the BOC even began cutting rates, that this was a precautionary tale, and this is exactly what we're seeing in the marketplace today. So again, I'll be kind of curious to see at some point the sentiment will change. I don't know if that's in the next several months, but I suspect as you get into probably the new year, sentiment at some point is going to change. And when it changes, you'll be in a market that will start moving. I'm not calling for the next bull market, double-digit house price growth, but today, right now, inventory is growing, rates are coming down, right? We just talked about sub 4. That, in my opinion, this is the buying opportunity for a lot of buyers. This is the time where you can go in, sentiment is negative, you have the opportunity to go in there, negotiate, and grind prices down. There's a lot of sellers that are unwilling to move. They're sticky, they're stubborn, but there are sellers out there that have to and need to move, and there's not a lot of liquidity in the market. This is a time when you can really leverage and push on prices. You tend to see that in a lot of things like estate sales, where, listen, the person's passed away, the family's inherited this home, it's gone up tremendously in value, and it's been sitting on the market for 2 or 3 months, and they want to move on. They want to move the estate on. They want to clear it out. Those are typically where you see a lot of the deals. There's people that need to clear in this market, or someone that already committed to a purchase, is relocating, and they can't sit on inventory for 4, 5, 6 months. At some point, you got to move, and when there's no bid, there's no other bid on the table, you're able to grind the prices down. And so that's what we're seeing in my view on the marketplace day to day, is that despite rates coming down, which is great for the borrower, prices are still easing off. So we're actually seeing affordability finally improve, albeit at a very, 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 very slow pace. So that's kind of what I'm keeping my eye on. A lot of changes from all levels of government. From CMHC last week to OSFI this week, mortgage rates coming down. What's going to be interesting here where I am in BC is watching this provincial election. You've got the NDP, you've got the Conservative, very different housing platforms. There's some crossover there. I'm going to dissect that for all of our BC viewers here. I will break down the housing platforms before you guys go to vote in a couple of weeks from now. I'm still trying to get on, we just reached out this past week, trying to get John Rostad and David Eby on the show separately. Long-time viewers of this channel know I had David Eby on the show probably 4 or 5 years ago. Looking to get them back on so we can get at least an in-depth interview and understand their policies. And maybe it'll happen, maybe it won't. The line is out there, the invite is open. But if they aren't, I will unpack their policies. Nonetheless, I'll try to give you the nonpartisan overview of what I think about their policies, particularly from the housing side. So hopefully you guys can make at least an educated decision when you go to hit the voting polls. And it's going to be a close one. It's depending on the day that you kind of look at the polls, it's close to 50-50. So it's going to be pretty interesting as things progress here. And we'll have lots of coverage of that moving forward. So, as always, hope that helped, and we'll see you next week.